Good evening, Mr. Crowley. How are you?
Pretty good. How are you doing?
I'm not too bad. What brings you into Dean and Sam's Financial Services today?
I've come into some money and I wanted to see what I could do with some investing.
Okay, well, what you can do with investing, the key part of investing is first you need to establish a plan. Because if you fail to plan, then you plan to fail. That's with life and most certainly definitely with investments. So what you want to do with the plan is you need to establish clear, set, obtainable goals, and we need to evaluate and see what your risk level is. What do you think about that?
What kind of investments are there?
Okay, so there's basically three types of investment vehicles nowadays. One is real estate, one is stocks, and the other is bonds. Real estate's basically like raw land or farmland, or you could have buildings, warehouses, stuff like that. That's your real estate. Usually when you buy those, they usually gain in value. Sometimes they do because of the housing bubble that happened last time. There is a risk of losing some money. Stocks are where you actually buy a part of a company, like Ford Motor Company. Right now they're trading at right around $13 a share. So you can purchase certain amounts of Ford, and when you purchase a certain amount of stocks, you get voting rights. And if there's any dividends issued out at the end of the year, like if Ford makes a bunch of money, then their stockholders get dividends. The other type is the bonds. Bond is basically a debt. So let's say the state of Missouri is issuing a $1,000 bond at a 5% interest for 10 years. What they're doing is they're borrowing that money from you, and they're telling you that at the end of 10 years, they will give you back the face value of that bond, but you are going to get the rate of return on the interest rate, either annual or semi-annual. So those are kind of some of the differences between the three types of vehicles.
Alright, so how do I start a plan?
Okay, as I said earlier, so what you need to do to establish a plan, what are your goals? What time frame are we looking at? What do you want and when do you want it? What do you want with your money?
Just live comfortably later on.
Okay, so let's just say that in 20 years you want $1 million. So now that we have that goal, we can try to formulate a plan. We could look at some investments to kind of gear your money to that end state. So with that, with your age, we could kind of be, usually what I kind of recommend is you be aggressive at the front, and then as you get closer to your date or closer to when you get older, then you kind of taper back and you kind of go into the more, like the fixed income stuff that's a little bit more secure and not as volatile.
How much should I invest?
Okay, well, first of all, you have a lump sum, and that's good. You could just start that off right off the bat with that. But typically with your income, you want to do 10 to 15% of your after-tax income. That's what I recommend. Now, this is also given how much amount of debt you have. If you have student loans and all that, I typically like to recommend that you focus on paying off your debt before you go heavy into the investing. But overall, around 10 to 15%, that's what I recommend.
What do you recommend for me to start with?
I recommend at your age, and what I typically try to steer people to is a good growth stock mutual fund. With you, we could do an aggressive growth. Sometimes you could do those with like emerging markets or international markets, where your rate of return is greater, but your risk of losing is greater. And the reason why we could do that when you're young is you can make money really quick, but you could lose it, but you have more time to make up that money. So as I said earlier, so as you get closer to your end state or when you get older, then we could shift that money to the more stable investments like the fixed income, the bonds, and all that. So any questions on that?
Nope, thank you.